You know what you're watching. DS Learning. Whoa.
Dollar cost averaging or lump sum investing? Which one should I do? That question goes way back. Way back. Probably since the Haitian days, guys. I'm not gonna lie. I'm here today to let you guys know what strategy I like to use. But before I can do that, I actually need to present to you what strategies are available. So what is dollar cost averaging and what is lump sum investing? Keep watching. Keep watching. By the way, guys, I apologize in advance if you hear any background noise because the bin men have decided to come around this time. Instead of them to come early in the morning, they've decided to come around 12 o'clock in the afternoon. So I'm not agitated. I'm very calm, guys, as you can see. But yeah, I apologize. Anyway, starting off with lump sum investing. It's the traditional way to invest. So i.e. you put all of your money into an investment in one full swoop, in one go. The key with lump sum investing is that it's an art, it's a skill, guys. It's a skill, okay? And the most important part is perfecting your time of entrance. Whenever you're looking to invest all of that money into one investment, you need to time it perfectly. And the best way to do that is by actually buying at the lowest price possible for that investment. Obviously you're looking for it to gain value in the future, but you want to ultimately enter in at the best price possible, the cheapest price. So for this graph, imagine it's a share price versus time graph. You want to enter in there because that's the lowest price possible. Cool, very simple, but there's a lot of risk involved because you and I both know that it is hard to time the market. It is very hard. However, dollar cost averaging is probably the opposite of lump sum investing. And by dollar cost averaging, what you're doing is you're not trying to time that perfect opportunity to enter the market. Instead, you're going along with the market. And typically what it involves is you invest in a set amount frequently. So within the stock market, it tends to be every month. People who dollar cost average, they tend to dollar cost average on a monthly basis. So what you're saying is, I'm going to invest here, I'm going to invest here, I'm going to invest here, and so on, consistently, the set amount each time, every month for this stock, whatever it is. And what that therefore means is that you buy overvalued stocks, you buy undervalued stocks, and so on. It's literally going along with the market. So you don't have to worry about timing your investments. But guys, please remember, that every time you make a transaction, you have to pay fees and taxes. So using dollar cost averaging really racks up your transaction fees and your transaction taxes, because you're basically investing on a much more frequent compared to lump sum investing. So bear that in mind. So even if you're doing the maths, make sure you incorporate the taxes and the fees into it, because you'll be shocked. You'll be shocked how it can really add up. Now let's talk about the facts, the numbers, the stuff that I like. Vanguard actually did a research comparing dollar cost averaging to lump sum investing. And it was interesting what they found out. So they compared it across US, UK and Australian stock/bond portfolio. It's dating back since the 1920s, according to the US market. So it's covering a good spectrum of time and obviously data. So what they did is they compared on a consistent basis and fairly compared the effects of using dollar cost averaging compared to lump sum investing. And what they found out is that 2/3 of the time, so a good 67 to 66% of the time, lump sum investing actually came out on top. So you would make more using lump sum investing rather than dollar cost averaging. But guys, you know it, and I know it. This is all about context. Lump sum investing is based on a huge assumption. It's based on the fact that you can time the market perfectly, which is hard. I'm not gonna lie. Warren Buffett, arguably the best, the most successful, the Rolls Royce to the investing realm, he still can't time the market perfectly. He can obviously pick up certain trends and he can give good predictions, but even he can't time the market perfectly. So I'm going to struggle timing the market perfectly. My point is, this is heavily based on you being able to time the market properly, which is impossible. So lump sum investing, yes, it may be better, but is it a realistic projection of us investors, what we can do? I don't think so. And that's not even the key part. The key part is out of the 67%, the 66% of the time where lump sum investing came out on top, it was only making 2 to 3% more than dollar cost averaging. 2 to 3%. So I think you guys can see where I'm going with this, yeah? All in all, I prefer dollar cost averaging. But let me tell you guys the reasons why I prefer. One, I am not a millionaire yet. That's the key. And majority of the human population are obviously working, they're making a good amount of money, but there's a lot of people that are actually poor and there's a lot of people that are in the working class. So compared to the human population, it's only a small percentage that is actually considered wealthy with hundreds and millions and billions and quadrillions and whatever of money. Like, it's a very small amount of that compared to the human population that's actually wealthy. So majority of us are the people that don't really have that much money sitting in the bank account to invest with. So that's a big one, because it means we're not given that opportunity to lump sum invest. We're not given that opportunity to just take all of this wad of cash and put it into one investment at one particular time. No. So a much better way for us to manage our investments is to actually do it bit by bit, because obviously as we're working, as we get a monthly payment, we're going to put a bit of that monthly money into investment. It's much more realistic objective for the working class, because that's majority of the population. I fall into that. So for me personally, I'm kind of forced into a situation where I have to dollar cost average, simply because I don't have the funds to lump sum invest. Two is for you to even lump sum invest. So even after you have those millions and quadrillions and billions, whatever, of pounds or whatever money, you need to be able to time the market. That's massive. It's unrealistic. It's impossible to do, guys. Yeah. So what that therefore means is that when you're lump sum investing, you're not timing the market perfectly. You may be timing it good. You may be timing it there. You could even be timing it wrongly there. But you're definitely not timing it perfectly, because it's impossible. So what that therefore means is that the benefits that you get from lump sum investing compared to dollar cost averaging is minimized. So that 2 to 3% is smaller. And what it could get to is, if you're investing there, you might as well just have dollar cost average, because you're going to be making more money from dollar cost averaging compared to obviously lump sum investing if you time it wrongly, which we're humans, is something we can easily do. So for me personally, dollar cost averaging seems to be the way to go. But guys, this is just what I like to do. I'm not saying you should follow the method, but I'm just saying you should think about the options that are in front of you, if you get what I'm trying to say. And this doesn't completely rule out lump sum investing. Personally, I own stocks in direct line. So when I'm dollar cost averaging with direct line and I see that share price is particularly low, I might put more than what I initially put, more than my set amount at that particular time, because I know that it is low at that particular point compared to other points during the journey. So that's why I might use a combination of the two. So I might not just stick to dollar cost averaging. I might put more of a lump sum into one particular installment whenever I'm looking to invest at a particular moment, just because I know that opportunity is optimum for me to make more money because the stock is undervalued. So don't completely isolate yourself, guys. Don't do that. You've got options, and it's there for you to maximize those options and make the most of it according to each and every scenario. Cool. And oh yeah, I forgot to mention that whenever you're dollar cost averaging, make sure to meet your minimum investing requirement. I've actually done a video on what makes a minimum investing requirement a minimum, but so yeah, if you want to find that out, check out this video right here. I'll leave it there. See, let's see what I did there. But yeah, check it out and you guys will see that you don't want to be investing in a low amount of money, too low, because it will therefore mean that your investment has to make more interest to accommodate for the lacking money initially put in. So you want to meet a minimum requirement at the very least, if not more, and put that in on a periodic basis if you're dollar cost averaging, for example. If you guys want to find out more on this and also more on just gain some more knowledge on the stock market, I've done a reading list in the short description box below. Check that out. Cool, because there's some gems there. Gems. It's your favorite YouTuber, guys, Dami Saharu. I talk about stock market investments like this one. I talk about property investments and financial management too, giving you that consistent content, you know. Before you guys can go about doing whatever you're gonna do for the rest of the day, you know what to do. Like, subscribe, and share. DS Learning Finance. Whoa. Bye, guys.
Whoa.
Ah!